are lesson number 8. So we see you on the other side and welcome to the Wilson County Library Seminar. Okay, here we are. Good morning, and we are on lesson number 8. Lesson 8 is going to be a review. We're going to do a little review here right quick. As you remember, we recognize some of these different charts, and the name of it, this is a bar chart where the open of the market and the close, the low and the high. The bar chart is used as a single vertical line to mark the trading range of a period. This could be intraday, the regular day trading. It can be a daily, it could be weekly, monthly, and then you can open the chart where it can be as much as 1 year, 2 years, 10 years, 20-year history. You're going to be like a long-term investment. You would like to do it in monthly and see how the stock behaves on a monthly basis. So let's move on this. This could be a little bit, take some time to explain, but it's very important if you're going to be a good investor, if you're going to be a good day trader. You got to recognize the signs and different patterns to develop during time. So here's one, for example, a line chart. A line chart is normally comes with mutual funds. The reason that it comes with mutual fund is that mutual funds don't settle the price until the end of the day. So therefore, during the day, the mutual fund might have 40, 50 different companies going up and down, some up, some down, and what have you. And we don't know the price of the actual fund, the billions of dollars that might be invested, until the market close, and then all those prices within the winners and the losers get settled, and then we get a price. If the majority then lose money, well, we're going to have a downside. If the majority of them have an uptick, so we're going to have an upside on the fund. So here we're going to look at it like May 20, 2018. It closed at $23 right here. So all we know is that from the day of May 19, it was the same, because it's right here. You can see that it's a flat line and then move sideways. So price did not change. Now on May 21, at the close, it closed at $27. However, during the day, we don't know what happened. All we know that when all the prices are settled, then we move the line from this point here to this point here. On May 22nd, it dropped a little bit, so then we draw a line here where the price settled. But in between, we don't have no idea what had happened. So you normally see line charts in places like mutual funds. You cannot do this for day trading. You cannot do this stuff for any kind of thing on it. You just got a general idea, and you're letting the hedge fund managers or the fund managers, the experts, take care of business for you. When you don't like it, you just sell it, and so on. So let's look at the next one, and now we have something, candlestick. When we deal with candlestick, can be applied in many ways. You can have it done by minutes. You can have it done as it takes away during the day, live. You can have it by daily, weekly, month, and then you can adjust it on the time, how much time you're going to develop it. If this is going to be 1 day, if this is going to be 2 hours, if this is going to be a whole day, or maybe each bar represent a day, or each bar can represent a week or a month, and then the span time is coming into, we do it daily. Well, this was yesterday, and this is today, and next day, and we can look back a month back where it's been going on. Some of the chart systems, they go ahead and put colors on it. So a red one, of course, is a down day, and a green one is an up day. And then you got the wicks in here, how far down it went, and how far up it went and where it settled. So it opened here, it closed here, but during the day it went this high, and also during the day it went this low. Uh, you notice that those bars there indicate what coming up, and it's any change in trends. It's going to develop in here too, so we'll see about that much later. So we're not here in the patterns yet. So the line outside of the body is not at the wake of a shadow. So here we go, and now we have those that have trends on it. As you can tell, this must be a much longer deal, right? Because we have from 2010, 2011, 2013, 2014, as you go down the line, what the stock particular had done. So it could be a monthly one, it could be a weekly one, but we know that through the years it's an uptrend. So some of this trend lasts many years. As you know, the stock market, we've been going up since 2009, when the market crashed in 2008, and we went down to close to 8,000 points, and today we're about 33,000. So they have been a long, long journey, but it got his up and downs on the way. It's not all smooth, and in between people lose a lot of money or make a lot of money. So this is a hard uptrend. It's a bullish trend, and you look for that when you buy your stock. It's in a trend. That's what they say. The trend is your friend. So trend lines are very valuable tools to recognize if we are doing a bullish or bearish or sideways trend. Here is a light down. It's very likely bearish trend. It's going, downhill, but it's not a very steep one like this one, but it's going down. So we draw a line from the top. And then when we find the next one here, we can trend it here. We say, hey, they seem like it's going to continue that way. And this line works as a resistance. Notice how we draw the first line over here on the uptrend. And we put a line here and then draw it further up for the future. You will notice that once in a while, the price come and touch that and then bounce again. So some of this line work as a resistance, and it worked for many, many years. Over here, we got a hard downtrend, So here, somebody forgot a T over here. It's going down and it's going very fast. You don't waste much time. We do this, and this is a daily chart, seeing like 1, 2, 3, 4, 5. Every week, it just gets worse, 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 worse. So within 3 weeks, this thing is down to some place. Then you get what I call channels. We got channels in here. That means that the price goes up so much, come back down, goes back up, but it always never go below the top line and the bottom line. The bottom line is a support line, and if the price crosses that, then it becomes a resistance line. As you can see over here, the upper line is the resistance line. The price goes up, get close to that, and then drop again. It's a good sign right here that it might have tendency to go back up again, because it don't go all the way down, but it don't make it. You try to cross it and come back down again. We see here that it does the same thing. It bounces against there, go back down very close to the bottom, and then when it breaks out, price can go up very high. So I'm going to show you and tell you that, for example, advanced micro device was about in the trend between $6 and $8 for over 24 months, 2 years that the price went up like that. Eventually broke out to 12 and 13, and then that established the new trend. And since then, that it happened like in 2018, 2019, now it's about $83. So when you see sideways movement like this, rest assured that sooner or later, two things going to happen. Either the price going to collapse even lower, or it's going to break out. So you have to wait. However, For a day trader, it's a different story. A day trader can be moving over here within $6 and $10 or $8 up and down and make some money. But this is a different type of trading and a stock. This when you're a day trader, you're only interested on the movement of the price during a particular day. And if it's down, he can short the price like here for a couple of days. If it's up, he can go long, or he can buy an option to go up, or when it go down, he can buy a put. Now that we mentioned options, stock options, always remember that to trade option, you have to sign a different agreement with your broker. And if your broker is not telling you that and you're not doing that, be careful, because it can get you in a lot of trouble. Not all the brokers are the same. So most brokers and the one that I deal with it, we had to sign an agreement. We had to prove that we had the knowledge. We had to prove that we had the experience and for how many years and so on. And this is part of it to protect you for losing money. So most people say that options are very risky. They could be if you don't know what you're doing, but we don't get into very complex options. We only do regular calls or puts, and that's about it. Or we sell covered call to hedge our purchase of the stock. So some long-term trades, also a monthly chart, it can be used. The longer the market has been in trend, the more significant is the trend line. Bullish trend line moving upward should be viewed as a support until they are broken. Likewise, trending moving downward should be viewed as a resistance until it's broken. So therefore, you must remember those things. Now right here we got also call it a channel, but also call it a trend. And you notice here, identifying the true trend change can help improve your entry and exit timing. So when you're going to get in, if you get in here and you wait till the trend is established, so we know that we're coming from a downtrend, and here come the reversal, and there are certain things, we talk about it later, that is signal is the reversal is taking place. So we never get in at the bottom. We get in someplace in here when we establish the trend, that we can draw a line from here to here, say, hey, okay, now we move in here, and we stay regardless if it go up and down, as long as it don't break the bottom line. If it break the bottom line, then I mean it's time to get out. So entry point going to be someplace in here, trend going to be established right around here. We now know that it's moving very well. It got several ones. We can draw a line and project it from here, from this point to here. We're going to make it longer, and you notice that they come out eventually bouncing there, so it's doing exactly what it's supposed to do. So the price, when you establish a line, that this line, the first line at the bottom, going to establish from this point all the way up this way. The other one, we don't have a chance until we get this and it comes back down. Now we know, okay, it's going to be somewhere in here, and we draw that. Similar deal right here. This is a downtrend. We didn't put no bars on it, but you can tell how the price, similar to the one on left-hand side, the price is coming down, and then it got all the averages and everything in there to tell you where this is going. So some of the tools that help you how to do that. Channels are simply a pair of trend line movement in the same direction to identify the support and resistance. Like this is down, and the price go this way, but never go higher than that, come back down. So you always get a lower high and a lower low. So every low side, this is a low, and this is much lower than the next one. Then it go again, but it's a lower high, and then eventually it might break out. Channels are the same way, similar to this. This is, I think this is from advanced micro device way back then, when it was very low and it went for many months. Some of them go for years like this, and then the price break up. But remember, you don't get in because it's going to go up only the trend have been established. This thing can go even lower the other way around. So don't jump into it and making it always happen the same way, because that's not what really happened. You got to make sure that trend have been established. Give it a chance to see something else is not going to change. So channels are normally used by more aggressive traders who want to capture the near-term and counter-trend market swings. So it's not for everybody, but it's a tool that you can use to do your investments or trading. Right here, this is what they call a bullish flag. This bullish flag is very interesting because the trend is upward, and we can see it going up. So if we draw lines in here like this, it's gonna hit someplace in here, like that. But in between there's some drop, and this could be a change in trend. We don't know that at this particular time in here. We don't know that. However, what you do, it takes time. So flags and pennants are created by the result of the sharp high volume market move, whether it's up or down. So we went up for several weeks and months this way, and now we need a rest. And this is where the resting taking place. Now, both formations usually last 1 to 3 weeks before the long term. So we can have from 1 week, this is 1, 2, 3, 4, 5, 6, 7. So this is a daily, will have been about a week, but it also can last 3 weeks. So it can go down like this, and this is called a flag. So this is kind of the flagpole in here. We got a flagpole, and here comes up. And then once they get absorbed, and some of the people that taking profits sell, it drives the price down someplace in here, and then it continue on his way up. And now we have a change of trending here. This is developing into a head and shoulder that we're going to look at later. So we start visualizing a pattern. This is the shoulder on the left-hand side. Here comes the head, and now here we got a shoulder on this side. And if you've been on this ride for so long, I will consider getting out here, because this is going to change direction. Once the flank and parent formation has been completed, the market typically resumes the original trend. Notice that they say typically, with higher volume. So if you have a higher volume going here, that means we're going to go. If we have low volume, there could be some problems ahead. Now, so this is a bear flag. Why are they calling it a bear flag? Well, it's bear flag for the simple reason that the trend is down. And it's indicating that the trend is going to continue going down. And that's exactly what it does. So even so it's going up, I normally call this a bear trap. The guys see the price going down, and they say, oh man, it's lower, so I buy because it's lower. Never buying down. Never buy price going down. A lot of people are going to argue with my theory. I really don't care if they disagree with me. Everybody got his way of doing things, but I have known a lot of people who have very bad experience when they buy a stock on the way down, and it continue to go down, and then they're suffering and painful because what they bought cheaper at one time is much cheaper now a week later. They buy some more down here, and guess what? It's going to go even lower, and then they accumulate a massive loss. Some people will say, well, it's not a loss until I sell it. Well, I don't believe in that. It is a loss. It's the money that you have had decreased in value. So a bear flag, it gives the indication like it's going back up. Don't fall into this because it's not. The trend is down, and it's just recovering. Why is recovering? Why the price going up if the trend is down, right? Well, it's the opposite of going up. When the trend is up and you get a bull flag, those guys that make money gonna sell to cash in, right? Like we see right here, this is a bull flag. The trend is up. However, a lot of people bought down here, they made money, and now they're cashing in. And a bear flag, the same thing happened. What you have to understand is that when you buy a stock, somebody on the other side is shorting the stock for you. Always remember that. When you buy a stock or whatever you buy commodity, somebody is taking the opposite side of you. You're thinking that it's going to go up, and he's thinking, well, I don't think it's going to go up, so I'm going to short it, and when it go down, right, I'm going to buy it back. Well, the way that happens is that when you short the stock, you actually drive the price down. It is considered like a sell as far as the market concerned. So when you short the stock, it drives the price down even lower. But when you have to buy that contract back, when you buy that contract back, guess what happens? It's considered a buy, and therefore it drives the price up. So always remember that this is come from years of experience that I have. Remember, I've been doing this in 1972. You can do whatever you want to. I don't really want you to lose money, but never bind down, and don't fall for this little bear trap here. This is what I call it. It's a bear trap because the price starts going back up, but it haven't broke the high yet, right? It got to be higher than this for me to think about it. Things are changing. And what happened is that those people that sold the stock short over here, if they sold it here at 100 and now we're down to 80, they're making $20 a share because now they can buy it back for 80 and they make 20 bucks. So if they got 1 million shares, there's $20 million involved in here. If they got 100,000 shares, it's quite a bit, right? So they start buying back gradually so you won't notice it, and it gives the impression that. So the sharp move, I mean, they're buying back. So we want to see what the dust settles to see what's going to happen. So this is what is called a bear flag. And that's exactly what it does. It goes back down. The trend is down, and so temporarily you see this. On a bull one, an uptrend, the same thing happened. Those guys that were long on the stock, they want to cash in. They want to take money out. So when they buy back this stuff, when they sell the stock, it drives the price down. Over here, they're buying it back to collect the money that they made from here to here. On the downside, over here, the buyers that bought the stock, now they're selling it to cash in. So it's the opposite in this one. This one is buying back the contract. This one is selling the stock to make his money. And then the trend continue on the right direction. So flags and pennants are created as a result of sharp, high volume. Again, market move and need the market to take a breath. So it's going to slow down a little bit and rest for a while. So here we are now. Right here, this is very important. This is a pennant, and they call it pennant because the sharp edge that it formed, this look like a little flagpole. It get like this. It's very important, right? Flag and pennants are created as a result of sharp, high volume market move, and the market take a rest. Both formations usually last 1 to 3 weeks again before the long-term trend resumes, and may be on the shorter end of the bear market. Once the flag and pennant formation has been completed, the market typically resume. It not always do resume his trend. So here's a pennant, and there it goes. You get some triangles, and swing traders like this, you know. This is a daily chart price move triangle. So the price come back down, get way down here, so they mark here point A when they got this sharp move over here that on prices. We got a sharp move over here on price. They mark this at 0.8. That's the big move right here. And then they wait, right? So you see that it's gonna start moving up. So they draw a line from here to here, and that's point B. Now, when you draw this line in here, you're gonna draw, this is your firm marker. You're gonna mark from here to here and draw it way down in here. We don't have no lines yet, but now we're establishing where this is going. Some people trade on this, we don't. What we're expecting is that the price gonna break out. When we get over here to point D, then we draw the blue line and cash it up here. So now we have established that the price going down, it has rebounds. We draw this line first because it's going to happen much first than the other one. So we're going to draw the line in here like that. So we're going 0.8, you know, this is where it reverse. Now we're going to point B and we're going to draw it from here to here and extend it way down here until they cross. So at the price get more compressed, before it was more movement in here, up and down, notice that it never had gone below this, but we don't know that until we get to point E. You see, so A, B, C, D, E. So now we know that as the prices are narrowing down in here, they're going to be a breakout, and that's exactly what happened. This is where we get in at point E. Once it breaks this line, this is the time to consider we need to move in. So this is very important. If you are an investor or a trader, you start looking at these patterns, you know, the market is moving down all the way down to 0.8, and market move up at point B. This is when finally we know that it's going down, and that's when we're going to draw the second line, our first line, and then this one here at 0.8, that's going to be our second line in here, and they cross. So it takes a while to find out where we're going to be. So this line going to take much longer than B. B is, we're going to draw it right here and wait to see what happens, because it might keep on going down, right? Well, it so happened that now, boop, it went below that, but it closed higher, and then that's where we drop our line. It's okay, here we go. Take it out from here, and at point C, we can go and draw a line through there, just about here, and come up this way. And now we know that the next three moves, if something gonna give, we're either gonna go down, or we're gonna go, you know, up. So right here, we're looking right about 37 days, you know, and this is just about 7 weeks. Traders like to see price form a symmetrical ascending or descending triangle on the chart, because they reveal a clue. It is give you a clue of where the market is going. Over here we got a descending triangle resting in downward trend. So you draw a bar over here when you see this, and you come up in here, you can draw a line, you know, and you can draw a triangle in here, and a confirmation that this is, it breaks down here. You notice that it keep on getting lower and lower in the triangle. The movement of the stock keep on moving a smaller bit. The prices keep on dying down, you know, much move, and then eventually here you take this big drop, you know. So it's something that you need to remember. This is a descending triangle. Then you get rectangular, like I told you before. They go up, it rests. So we could have an accumulation dealing here where there are guys buying and others selling, and those that are buying, they're expecting to go up. We don't know yet, but that's the way it is. The people that are selling, they're accumulating the profit, and the other one that be buying, they're expecting to go up. So normally this is a company with a more volume to go up, and when you compare to this, so it's a low volume in here, that means that this probably going to fail and it start going down. So volume is very important. Over here, down there, you're going to get less volume, right? So not too many buyers, there's not much action in here. Now we go to this part here. This is a falling wedge, and normally you see the formation of this run again is resting again here from this big move, and some decision makers, that some of them are undecided, so they might call it falling wedge. You sit here and wait, or you wait them out to see what's going to happen, and then the pattern continues. So it's kind of resting. To me, it's just this much money being made, so we had to settle the account. Here is a head and shoulder pattern. It's kind of rugged type head and shoulder, but this is a pattern that is very common. You will see it many times that you trade, and every time on the uptrend, you say head and shoulder, that means that the price of the stock going to take a new direction. The trend going to change. So head and shoulder, but so it's the same thing, and that's an indication that the trend going to change direction. So it's all depending if you're short in the market, or it's all depending if you are expecting to go up. So we can make money on either direction, going up or going down. Money can be made. It's all depend on the position that you take. So we really don't care what we trade. We actually care more about the price movement. You see, we are technicians. We don't do the other stuff and research much information. We kind of see that whatever this chart tell us here it's already have been taken in consideration. They have a double bottom and we have a double top. So when it look like a W, you will see that many times, and it's telling you that we're gonna reverse. So the price is coming down. It make an effort to go back up, but it don't clear the previous one, and then it fails again. So many days, about a week, depending, so it's weekly or monthly or daily, and then make another move and it start moving higher. So that means that the price is going to change. Over here, the opposite, the stock was going up. Here we have the first top. It comes down, so it make an M. It's just embedded, and then it come back, but it's just about the same size. It don't break any higher, and then the price start. The big signal, you don't want to get caught here, because when the last leg of the M, it can be a very, very sell-off with high volume. So double top patterns are common sign of reversal. Market always could be forming a triple top or triple bottom. So you have to wait to see how the market unfold before jumping into the new trend. So we could have a triple top or triple bottom. So you can trade, if you're a day trader, you can trade daily on this, going up, and just like we do here, up or down on it. Depends if you're short in the market or not. But for long-term investor, you don't want to do this, because it's going to give you, headaches every time that this thing drops, and so you don't know where it's going yet. Here, what they call it's just like an island, and they call it an island because there's a gap in here between this price and this one. We don't know where it's going yet when this happens, but eventually we know that we don't make it newer highs. Comes in here, it create a drop and make another gap, and when that does happen, it's going to be a change of direction on the market, and sure enough, here it comes and it fall off down the cliff, big time. So here's one that it was coming down, and now we're going to reverse pattern, and as I reverse the pattern, you'll see a gap in here between these two. You don't go too far, it's just a small price movement, eventually make a gap, and then it come back down. So you open this little red, it's open way over here by hitting hole. Next day it's way down in here. You make another attempt, but it don't make it. Comes down this way. You make another attempt, but it just don't hold. A day later it drop again, and they continue. And when you get down here, here comes a little gap. It's a lower price than the previous one, but end up at a higher, and then it finally breaks out and it takes off. So this is a island bottom reversal, and both of them, one is going up and the other one is going down. So if you're a long-term investor, you need to look at this. Long-term trader, you trade in by the months and stuff like that. On a day trader, he don't care. He's just gonna get in here one day and he's gonna exit within 2-3 hours later during the day. So in reality, he don't care what it is. He's only just like us. He just taking advantage of the movement of the price in a single day, maybe in a couple of hours. So price change by the minute, by the seconds, up and down. And if you're fast enough to get in and hold on to it, you can make some extra money. We're going to see that at the very end when we move in at the end of the lesson. We're going to show you some of the trades, and you see how this is done. Here we got candlesticks. They got different names. Dodges. Dodges could be an indication of reversal, you know. The depth of dimension, the standard bar chart, in addition certain patterns. So if you're looking for pattern, it will be the right thing to do. And consider this when you see signal a weakness in the market. As you notice, the price opened on the same price of yesterday, and it goes up, but the bears push it down all the way down here. The bulls take off again and push it, but they cannot overcome this. So now it ends right here. Normally, when the hot color chart is red, it might be black on the other one. It don't matter. It's all depend on the trend. If the trend is up and this stuff starts happening, you got to be careful, but that means we're just running out of gas. We cannot move the price in either direction. If the price don't move, money cannot be made, okay? So remember that. You can only do it a day trader. He's trading between here and here, and he in the morning up in here, he dropped this far, and then he jumps in and hold it here for 15 minutes. He made money, then he sell, and at the end of the day, finish here. We don't know exactly where it bounced on it. We will have, this is a daily bar. It's not a minute bar to see how this was formed. So the formation is very important. And the weakness in selling pressure, it appeared after a long red bar or downward trend pattern. Here we got the Grape Tunnel. You know, this is sort of like when you go to burial place and you see all the gravestones there. You got a base at the bottom and the stone is standing up. Someday my stone will have something like that on it. So it's an upside down T, and then you got the other one, and it could be the other way around also. The long-legged dodgy, this is the Grape Tunnel dodgy, this is the long-legged origin. This is not exactly on the middle now, but it's much higher, but it opened on the same place and closed on the same place. This movement formed a long shadow at the bottom side, on those sides of the chute. The dodgy could be more important after uptrend. So it could be indicating that the price, we're going to turn in a different direction. If we were going up, now we're going to be going down. Normally, it's in a bullish, bearish, engulfing line. This is another type of chart that interpretation is based on what's happening here. So we're coming down, but it's a bear trend that start coming down, and then you get a red one, like it's here, the black one, and then you get a large green one, like this one here that is white. It don't matter. All this simple here say that it was the down day and this it was an up day, and of course we know that it opened here and it closing here, and it engulfed, it just covered the entire previous day. That's an indication that the market gonna go up. And sure enough, we can see here, we got a test here, like a trying to, but it don't overcome this one. So you gotta wait to see how it's gonna develop, and finally it take off. Here's the opposite one. This is a bearish one. This is the one that engulfed the same way. Engulfing line. This pattern is very bearish. It is occurred after a fairly large uptrend. So if we have uptrend for 4 or 5 months, like I have seen it before, and this guy shows up over here, it's time to get out of Dodge City, because this could be the end. We stand on the fence and wait to see what's going to happen. There's no rush. The market going to be open next day again. Going to open next week. It's going to be here next year. So there's no rush to jump in and lose your money. Take it and wait. Patient, patient. This is just like a fisherman. A fisherman go out and he just patiently has to sit there to catch the fish. He just don't come just like that. We got another one here that is called dark cloud. And dark cloud is when you're going up and then you get a big, this red last day, and it has to engulf, cover more than 50% of the previous day. And it's obvious this guy did. It covers 75% of the previous day, and this could be an indication that we're going to have some changes. So this is a bearish pattern. This pattern move is more important. Is the second line body is below the center of the previous line body. So it's obvious that this is way below the middle of this one. This is going to change. We can see here, dark cloud is right here. We can tell how this is way up. This guy comes in here like this and just drive it all the way down. He engulfed all these 2 days, between two of them, engulfed the previous one. Bad news. Next day, boom, big gap. He make an effort to come back, but it's not big enough to come back in here, and then this probably continue down. The morning star is a little different. Morning star occurs when the market gap lower with a green body, right? So it gap lower with a green body. It's an update, but it's not covering this one. It just becomes, so it's a Chinese star. This is the one you see in the morning, 6 o'clock, before it start breaking in the morning. You may see the Chinese star over there, so that's what they call, they give it that name. So the third body that is in green candlestick closed well into the first session of the red body. So right here we're moving in, and this is a hint that we might be changing trends. It's not for sure, remember, and a lot of things can change this. Political deals, act of God, earthquakes, terrorist stuff, depending on what stuff you are, you know. If somebody go and bomb a whole bunch of bases or something in some place, the military is going to move in. So you in the airplane business, this is good for business because it might go for war. If you are in some other stuff, then it might change. So depending what happened, this is how the price change. And that can turn in minutes, you know. Recently, the other day, China clamped down on those guys on cryptocurrency, and all of a sudden the cryptocurrency lost 40% and people lost billions of dollars and trillions. The morning star, this is a bullish sign, pattern indicating, right, that we're reaching the bottom. And this is, we're going to come back. The morning star occurs when the market gap lower. Here we got another one, and then this is the shooting star, you know. It's going up, and then it shows up, the shooting star is shown at the top, but it's red. So we got to be careful because there might be change in trend, and this is how it happened. Then we got other candlestick, like a hanging man and a hammer. They're both similar. It's all depending the price is going down or the price going up. When the price is going up and you get a hanging man, it's probably some change. When it's going down, that means it's a hammer, and we're going to beat on this and going to beat you down or whatever, and the change going to be. So you have to see a little bit more of the pattern of the trend to determine where it come up. But when this guy comes up, you gotta be careful. Here we see, we can call this going up, right? So is this a hammer or is a hanging man? Look like it's gonna be change in direction of the pattern. You know, a shooting star comes up, and then we get another one over here. So the more handle, the more easy. So this is gonna be hanging man, because they're gonna hang you. The price is gonna go down. We get over here with a chart where they use the Bollinger Band, and what it does, it tells you if the stock is overpriced or underpriced. It's obvious that the price come down. It's telling you that even fall below the Bollinger Bands, it's obvious that the stock is in depressed. You know, it just keep on going down. But you notice now that we might get a reversal, because what? This band is getting narrower. It was very wide over here, and now we're getting narrower. This stock was going up at one time, and then here comes the little constriction in here, indicating that the price of the stock going to start moving down, and that's exactly what happened. And when it does, it takes a good dive. So when they plot the two lines, the deviation above the two standard deviation below the original moving average, it determines if it's overbought or oversold. You can take your video, stop it, and take a shot, and you can make a collection of those different things for pattern, and that I want you and ask you to remember. I cannot tell you better advice that remember this thing. The next one that we got here, right, is momentum. A lot of people like momentum, and as the momentum goes up, they expect the price to go up, but that not always work out that way, okay? So this kind of go flat. I don't like this kind of chart, and I don't use this specific oscillator to determine which way we are going. But a lot of people use it, you know. There's other one that have a better trend, is money coming in or money going down. Right here, we use averages. So we're using a 9-day average. A lot of people like to use 9 days. So if the price stay above the 9, they stay on the market. As soon as the price cross the 9-day average, they get out. And this is exactly what happened. The 100 days is below the 100, so once it cross this, it's going to go deeper. They also say 200-day moving average, and that one is, once it passes the 200-day average, we could call that the market is in a, or the stock is in a bear market, and it's hard to recover from those things when you way below 200-day price. Moving average is exactly how it sounds. They take the days, 9 days, and divide it by 9, the 9-day price, and they come up, they add them all up, divided by 9, and this give you the price of the last 9 days. So always drop one. This one take the price of 200 days, so this is where more smooth, because it takes longer to develop, you know, to see the line and see where we're going. Right here we have the MACD, and this is the moving average convergence. Back in the 70s, it was very popular. People bought a lot of money because it's very mechanical. As the signal move up, you buy. And when the signal start moving down, you sell. Don't stay there, because it probably continue. And then some of them decide that, some of them say, well, I wait till it get below 0, and as long as the stock is at 0, I don't sell. Well, you can do this also with indicators, and they got a trigger signal when to buy and sell. With this bar, they can be red or blue or whatever. So once they fall below 0, it's 0 line here. I think it's 80 and 20, or vice versa. They're telling you that it's oversold, and this is what they use and this is the zero line on it. When it's below this, it's bad news, but you notice that even so it went down this much over here, the price didn't change much. And the reason is, during the calculation, all this data is based on previous prices. Always remember that. It's on previous prices. This is not a crystal ball. This is an estimate of what could happen. So you got all these numbers in here, right? Very quick, fast drop that they show up in here, right? Out of nowhere. And they was already having problem because these numbers are very small. The variation, the price don't go anywhere. You finally get a shot and then come down in here. So the price don't drop much because there's been big drops ahead of it. So the calculation get kind of a little bit out of order. Once it passed this point, you notice that this mostly kind of mimic this movement in price and gradually come down like this. So when you get stuff like that, there's a distortion in the indicator, and there's not much we can do about that. We cannot predict that it's going to come down that fast, but remember that it's done based on previous information, so it's not a crystal ball. Right here we got the RSI, sound like my last name, Roy S. Idrek, but it's not. It's relative strength index. This is a calculation that we used to do years ago in the 70s by hand, but now thanks to computer, it can be plotted for you immediately. And it has its point of zero, right? And this is way too high, it's oversold. And then you got the signal that it goes below zero, that is, it's over here is overbought, and below zero is oversold, indicating like the price is, it worth more than that. But we're not gonna get into the technical part. All we do, they do is for trading, probably not for the long-term indicator, is that it's time to get in or get out. If you're a long-term investor and you're going to be 5 years from now, you probably don't worry about that. But then again, when the market crashed in 2007, toward the end of 8, it took about 5 years to recover that 40% that the market dropped. So you don't want to get caught in a 5-year recovery plan. So you see it, get out. I was talking back in March of 2007, 2008, that the market was not working and we were going to correction, and eventually when it happened, the market was about 16,000 and the DJ was 16,000, and by everything was over on 2009 on March of 2009, it ended up at 8,000. It lost almost 50% of it. Now here we got one that is the RSI, a relative strength, that it showed more accurate based on the price, when to buy and when to sell. You see, it comes over here. I like to use the slow better than the fast one, because this one is more volatile because it's faster calculation. And you can see here that when it gets down here, the blue line cross the red one, it's time to sell. And when it starts moving above the red one, you have to wait for the trend to get established, and we can tell right here it's established a trend. So we come up with the first dot, draw a line up like this, is okay, now we're going to get in. So you're not going to get down here at the bottom, you're going to get in here, and probably somewhere in here when they start closing up here that it goes over the line, it's time to sell. So it's a $20 move, and you got it 1,000 shares, is at $20,000. Here we got another one, and this is the open interest. A lot of people like to do that on volume. You can use many of those, but in reality, this is I don't like it much either, because it not always perform like it's supposed to. You got over here open interest going down, right, and the price going even higher. And you can see the volume in here to this bar There are a lot of people that want to buy this stuff. So it came in here, it come down gradually. So now it's doing the opposite, open interest increasing. You know, what open interest? Are they selling? Because sure, drawing the prices down. Over here, this is the open interest. Apparently they don't selling anything, you know, or not too many get involved after they got burning here. But some of these oscillators and indicators are not the best. There are hundreds of them. I only use 2 of them. Is the PPO, you know, and the other one I don't use even on the Mac. I use the volume, you know, and I track the S&P 500. This come to an end of the class for today, lesson 8, and we're gonna cover right quick a little bit of this here, show you what is lay ahead. We're gonna talk about cryptocurrency, what the banks are planning to do with the cryptocurrency. This is something new that's coming up. A lot of students are asking about that, so we're going to touch that a little bit. And now we're going to show you some of these trades. Some of these trades are going to be based on what we had done before. So let's pause the video here right quick. So we change the screen and move into the crypto or the trades that some of the students had done and how much money they had made and so on as a day trader. Okay, let's go over here. This is a 2021 trade. It was at the beginning of the year. I think it was on February the 4th, 2021 at 9:46 in the morning, as you can see here. This trade left a net profit of $5,000. And we went out probably 2-4. It was done on the same date, so it was matter of minutes in here. So what we did here is a Virgin Galactic, and we bought how many contracts? Let's see right here. Action, it was to sell. Okay, so the bot is here. You bought Virgin Galactic, and it was 800 shares for Virgin Galactic. SPCE is the code. Price improvement, it was $47,000, and we got an extra $29. We move in here with the stock at this price, and now it so happened that the price was 53, and now we're going to sell, you know, 800 shares per market price, and it filled up at 59. So we're coming from 53 to 59, right? So that's about $6. So we bought it at 53.09. We sold it at 676 times 800. You know, so that's at $59. So you take the difference of this stuff, and the net profit. You see, we're going to make from 59 to 53 is $6. We multiply that times 800. And this is $5,408. This was done all on the order was to Virgin Galactic. Let me see what it say here. Action sell. Okay, so it was 2 days. We bought it on the 2nd and we sold it on the 4th. So it was a 2-day trade. So we buy it on the 2nd, 3rd, and 4th in the morning. So we actually been in the market just about at the most 24 hours, because when you buy it on the 2nd, then on the 3rd it's going to be 24 hours. But on the 4th, as soon as the market opened, it was so much exciting, and here we got $6 here looking at our face with 800 shares. So we sold them all and made $5,400. Okay, right here now we got a multiple trade. We noticed that some of them on the 22nd and the 19th, but there are several days involved here, Friday through Monday. So we buying on Friday, and we can go buy and then we sell on Monday. So the Freeman McCarran, so on the first one of them was 1 day on 23 minutes. You see, so this one right here. We buy it in the morning, 222, and sell it in 222, and we net it, right? The price that we bought it, it was $4,000. We sold it for $6,000, and the net profit was $1,500 in 23 minutes. Now we got other transactions that come from the Friday the 19th and the 22nd, the 19th on the 22nd, right? So we actually buying, or we bought, and we netted $700 on this one. The other one netted $700, and this one netted $714. So you bought and you sell. So if you buy it, for $1,000 and sell it for $1,800, that leave you $714. We bought it for $1,000, sold it for $1,819. That gave another $789. We bought it for $1,000 and sold it for $1,800. It let us $766. This is a call, so we buy options in here. They got bought and you sold. That show you the price, and this happened in 2 days. So when you combine all this profit, the 1,054 from this date, and we combine what we made on all this 2,000, the 2-day trade gave us $3,776. So if you learn from this lesson everything that I have shown you, and you use those indicators that I tell you to be aware of it, you also can do the same. It don't take no art. What it takes is common sense. It takes dedication. This is not a quick dollars. This is about practice, practice, practice. And then when you got it pinned down to what it is, then you can do it. You know, don't go over there. I know a lot of people want to get rich quick, especially you're going to buy a doggy coin or a Bitcoin. Maybe yes, maybe not, but I've seen many things like that before, you know. And in my life, I have seen where people were buying pet rocks. People paying $5 for a rock that somebody got from the river because they're going to take it home as a pet. What kind of deal is that? It's a rock. But then again, we got dollar bills too, right? It's a piece of paper. But we say, oh, it's worth $50 because the government say it's worth $50. So as long as somebody take it and give you what you want, you don't even consider that it's just a piece of paper with a number on it. So this Bitcoin is no different. It's an electronic deal. You don't know where it's at. And as long as somebody honor it, everything is good. But if the government steps in and don't like that it's infringing on the government business, then it's going to be a different story. So with that, I think let you know that what's coming up next is going to be a little bit about cryptocurrency, what the Federal Reserve Bank around the world are doing. And remember from lesson 1, the Federal Reserve Bank is not part of the United States. It's a private corporation. Don't you ever forget that. Thank you for your time, and I'll see you on lesson 9, the final lesson.